Unless you've been living under a rock, you've probably heard that FTX, the second largest cryptocurrency exchange apparently by volume, collapsed in somewhat spectacular fashion last week, declared insolvency. And I'll give a kind of post-mortem breakdown of that in a future video. But for today, we need to talk about the various risks associated. CZ, the founder of Binance, the largest exchange, who had looked for a little while like he may buy FTX to kind of help bail it out, has announced that there are other exchanges likely in a negative situation. We've heard a bit about crypto.com, but there's other risks as well related to, for example, Tether, institutions, listings, banks, venture capital firms, and projects themselves. So in this video, I'm going to talk to you about what those risks are, and I'm going to give you, at the end, 4 steps that you should probably be taking to protect yourself if you're exposed at all. And I'm also going to share with you what are, in my view, the opportunities out there right now, because actually I think there's a ton of opportunity because of what is going on. So let's dive in. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. Thank you for your support. Thanks for coming up the channel. Check out some of our other videos. And with that in mind, let's go forward. So, first things first, we had a situation where, as I said, FTX, which was widely used by many people, including many VC firms, and its sister company, Alameda Research, led by Sam Bankman Fried, the young, kind of likable, supposed billionaire. I guess he was a billionaire on paper for that time, and very public figure, second largest donor to the Democratic Party, one of the leading voices and faces in the DeFi space, announced that they had been using customer funds. I guess they didn't really announce that, but it came out that they had been using customer funds for their trading. They had lost a lot of money. There was insufficient capital to repay the investors, and through a series of different issues, things went down, down, down. And now a lot of people have money trapped on the exchange. They hopefully will get some of that back. They filed for Chapter 11 bankruptcy, and then, as if it couldn't get crazier, they claimed they were hacked, and hundreds of millions, maybe up to a couple $1 billion in funds were supposedly stolen from the exchange. Lots of people think it's an inside job, so tons of controversy in this situation. And we've subsequently seen FTT, the token for FTX, delisted from places like Bybit. The token had already plummeted dramatically. The whole crypto market took a big dump. Bitcoin hit new lows. Interestingly, Ethereum and a few others did not hit new lows. Ethereum had previously bottomed in the 800s. It went down to, I think it was around 1170, something like that. Or no, sorry, 1079, something in that range. And things have since recovered a little bit. But it's noteworthy because of the fact that FTX was backing Solana very heavily. The whole Solana ecosystem was heavily FTX Alameda supported. Multicoin Capital, the main VC fund, which had gotten in and backed the Solana and the ecosystem, turned out to have 10% of their holdings on FTX, and they've announced that those funds are frozen. Travis Kling, another VC, mentioned that their funds were on FTX. He had supported them for a long time, and those funds are frozen. You have various different institutional investors, ranging from the Ontario Pension Fund to Sequoia Capital, I believe SoftBank, Coinbase Ventures, Kevin O'Leary, Mr. Wonderful, etc., were all investors in FTX, having put in hundreds of millions of dollars collectively. So what is the situation here? Well, clearly, anyone who invested in FTX, their investment has gone to zero. So that's done. The FTT token, anyone who has it probably shouldn't have it. It's probably going the way of Terra Luna, and it will go down to close to nothing in this circumstance. Everything else starts to become a little bit murkier, and I think it's worth understanding the key risks that are faced at the moment. And as a result, we'll get to what you should do. So the first is the risk that other exchanges may be in a situation where they also have insufficient funds to cover the depositors. Now, In a normal brokerage environment, you have this broker trust agreement where the funds of depositors, so the tokens that you would hold, or whether you're talking about also on interactive brokers, say the stocks that you're buying, are segregated. They're kept separate from the company's assets. The company's not supposed to touch those. And as a result, you're in a situation where if the company goes down, that doesn't affect you. Your assets get transferred to you with a different custodian, and off you go. That's supposed to be the way it is for exchanges as well, but FTX was a Bahamas registered entity, therefore it was not regulated. So if you look at something like Coinbase, Kraken, etc., these are typically pretty solid. They're US based, they're regulated. Coinbase is audited really well. It's a public company, so probably not such an issue there. The biggest one immediately that is a concern is Crypto.com. There was some really weird transfers that took place from Crypto.com. They had supposedly sent a fairly large amount of money to FTX. It's unclear how that played out. In addition to this, they apparently accidentally sent something like $400 million to some other exchange, which supposedly subsequently got sent back, although there was some discrepancies. So a lot of people are concerned about Crypto.com and the idea that Crypto.com could go down, part of the contagion that could spread here. Additionally, you're not sure about a bunch of other exchanges. Unfortunately, there's a lack of transparency. So unlike what crypto is supposed to be, which is a totally transparent public ledger, exchanges are not crypto. Exchanges are centralized finance, not decentralized finance. And they don't expose this. We've started to see a trend of something called proof of reserves, where an exchange will list their wallets so they can show what they actually have. However, this is not corresponding to, or there's no way of knowing what the proof of liabilities are. So if you don't know what the liabilities are that go with the assets, this is tough unless there's some sort of an auditing and third-party process around it. In addition to this, you have contagions such as FTX, SBF, Sam Bankman Fried, had previously bailed out BlockFi and Voyager Digital. So those essentially are going to nothing now. So anyone exposed there, that's a bad situation. There was a relationship with Silvergate Bank, and some people were concerned about how that might play out. This is unlikely to be a big problem, but could be a potential concern. Then you've got all the projects who had their funds on FTX and were paying out salaries, etc., to people. Suddenly those projects basically can't operate, and potentially those projects are going to go to zero as well. All good examples of why you shouldn't keep money on exchanges. I'm just going to come later to our end point and kind of a set of recommendations for you. The additional thing that we have here that could be problematic, although I think in the short term certainly is not, is tether. Okay, so the largest holder of USDT was Alameda FTX. We're kind of blurring the lines between them because clearly there was no clear distinction between them. Now, when this happened, Tether supposedly at the request of authorities froze in excess of $30 billion in a USDT wallet held by Alameda FTX. And so those funds are frozen. Now, the fact that Tether sent so much money to Alameda and FTX, and Tether is also very opaque, it's not clear what they have for reserves, makes one question whether that was a fair transfer where they had proper collateral, like money was sent to Tether and then Tether printed new Tethers and gave it to them, or whether there was some sort of a loan arrangement there. Hopefully, it was not a loan arrangement, and therefore they're not exposed to liability from FTX Alameda. We don't know this. The good news here is with those wallets frozen, so long as those wallets are frozen, it is highly unlikely that redemptions on USDT would exceed their ability to meet those redemptions. In other words, you've just got an enormous share of the USDT supply, which would be potentially liquidated that can't be liquidated because it's frozen. So that buys some time at least, which is really positive. The final point is, of course, you have the pressure of added regulations coming. So at the moment, when I look at the market, I see a few major risks. Of course, there's one that other exchanges will go down. Honestly, the likelihood of contagion from FTX to other exchanges is fairly minimal. simply because of the fact that it wouldn't be normal for an exchange to have a large amount of money there. There's often a small amount of money that is there. For example, Coinbase mentioned they had something like $15 million on FTX, and the reason is to facilitate essentially transactions and arbitrage between the two exchanges. $15 million is nothing for a deca-billion-dollar company, so that's not really a big deal. And I would say the same is true for most exchanges. You do, however, have the risk that other exchanges may have been behaving in a similar manner to FTX. I would say that the ones that you're probably pretty safe with are Coinbase and Kraken. Arguably, you could say Binance, but Binance is also pretty opaque, so hard to say there. The next thing that you have is you have the risk of tether, right? That's a big possible, if that was to happen, if there was a problem with tether, and we've known this in the industry for years, right? There's been always talk of what do they really have for reserves. If tether were to go down, it would be cataclysmic, right? Massive catastrophe. Now, there has been fear about this for a long time, and there has never been a problem. There's never been a case where they could not come through and redeem people's deposits exactly as promised. So we have no inherent reason to believe that that is going to be the case this time. However, I think it's worth taking precautions around it. In other words, there isn't a lot of upside, and the risk to reward is asymmetrically skewed to the downside, right? This brings us to all the projects that you're going to discover were hurt by Alameda, and so people are going to lose out in that regard. And finally, regulation. Okay, so these are kind of the four things that I'm looking at as possible negatives. This brings us to what should you be doing? So I think the first thing is the point that I've made since as long as I've made videos about crypto is do not store money on exchanges. So if you have money on exchanges, I would highly recommend you remove it from exchanges. I mentioned way back in the day when I first started getting involved in decentralized finance that the thing that attracted me to decentralized finance was I'd previously, even being super careful, lost a few $1,000s on two separate exchanges that basically exit scammed. And based on that, I think, look, you know what? I'm very much not interested in having money on centralized exchanges. I'm an enormous fan of decentralized. I've seen some comments on Twitter where people just didn't seem to understand and grasp the difference between centralized finance and decentralized finance. The problem here was not decentralized finance. All the decentralized systems worked fine. The problem was a centralized institution committing fraud. And that's just more impetus for why you want to focus on having your own custody of your own tokens in your own cold storage or hot wallet or something like that. So number one recommendation, I would say, take money out of exchanges. If you're going to have money on exchanges, if possible, have it on Kraken and Coinbase, maybe as a third backup Binance, right? I would say anything else, I would recommend just remove your funds. Is it possible that they're all fine? Yeah, it's possible they're all fine. But is the risk worth the reward? No, I don't think that it is in most cases. So the truth is, some people may say, well, what about trading? Okay, the best place to trade probably in a decentralized manner is DYDX. And so you can go and check them out. They're a really great, super fantastic platform, a lot like Bybit, but decentralized. It's a derivatives trading platform. Doesn't work for people in certain parts of the world, but generally those people can't make it work anyway, so that's fine. Next, I would recommend transferring all of your funds in USDT out of USDT. Transfer them to either USDC, BUSD, which is a Paxos product or similar, or DAI. Okay, so everything from USDT out of there. I personally, the portion that I had of my funds in USDT, I transferred on that basis. It's just, again, the chances that it's a problem are pretty low, but the risk to reward is asymmetric to the downside, meaning that it can't go up, but it can go down, right? So why wouldn't you hold it in something that you know is, in the case of, say, USDC or BUSD issued by Paxos, audited, you know exactly what's going on. Why would you deal with this opaque entity versus the other? Now, the main reason might be, well, I want something that is less likely to be censored, right? Certainly USDC, et cetera, are more likely to censor. So what do we say about that? Well, that's where you have DAI. So DAI is, long-term solid stablecoin. It's decentralized, et cetera. So any of those three, I think, are good places that you could go and take a look. What is next? I would take a close look at which projects are likely affected by this, meaning that their teams won't be able to be paid, right? And as a result, their projects could end up going to zero just because there's nobody building on them anymore, or that were heavily supported by FTX Alameda, okay? Those types of projects, I would look at removing funds from and allocating it somewhere else. This would be a lot in the Solana ecosystem, unfortunately. Now, let's just talk quickly about Solana. I'm by all means not saying that Solana is going to zero. Solana has a unique offering, and it's entirely possible that Solana goes through this and is successful and all these other things. However, it is undeniable that Solana was pumped and heavily supported by FTX Alameda, and their token is way down. I think basically what ended up happening was that you had a situation where, as FTX was trying to defend the price of FTT, their token, they started selling Solana tokens that they held, and the Solana token price crashed pretty dramatically. So is there an opportunity there? Maybe. Certainly, it's not like Anatoly and the Solana team are directly related to FTX, so it's not, like they will continue on doing what they're doing. But I think the likelihood that that project sees the same price success is probably lower, and there's probably quite a few projects. One of the things that FTX was doing is when they were investing in a project, they said you need to store your funds on our exchange, which is it's a warning sign, not good at all. However, the fact that they did it means that there's a bunch of projects that they were paying their staff from funds that were held on FTX, and now all of a sudden those funds are not held there, and so this is potentially a fairly significant loss. The fourth thing that I think is important is having alternate banking channels. So we can help you with this. If you're interested in help with setting up international banking, crypto-friendly banking, etc., please reach out to us. What's the idea here? The idea is there is a reasonable chance that what happened will accelerate regulations. And one of the areas where governments can put pressure is on the banking level. Since they can put pressure on the banking level, it is potentially likely that you will see some banks that were previously crypto-friendly become less crypto-friendly in terms of allowing on and off ramping. And so having backups to that, I think, is a useful, important thing to do. This brings me to the opportunities. So I am of the opinion that actually probably there hasn't been a better time to buy crypto in quite a long time. Like if you look all throughout 2021, you had things pumping, right? There was a lot of high prices along the way there. You want to buy when things are low, not when things are high. If you were to look at, for example, Ethereum today is at the same price as they were at their peak, actually a little bit lower than their price at the peak in 2017. Now, granted, it was overpriced at that point in 2017, but how much more building has happened in that ecosystem since then? How have they changed their environment to be deflationary, et cetera, et cetera? You're in a situation where a bunch of these projects being sold down are arguably quite a good deal. And more importantly, a lot of the risk has been sucked out of the system. So from a price action standpoint, here's how I look at it. What you will notice is when you have bad news and something fails to make a new low, that's often a bottoming sign. So if we pay attention to the Terra Luna, Three Arrows Capital, et cetera collapse that took place, we saw the market crash down a lot, and you saw new lows for that period of time. Was it a good time to buy? Yeah, in theory it was a good time to buy, just on the basis of mean reversion. However, you weren't sure whether that was a continuing trend. In other words, the trend was going down, 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 down. The trend had not reversed. At this point in time, if you look at something like Matic, if you look at something like BNB, if you look at something like Ethereum, et cetera, Atom, et cetera, what you will see is that they haven't revisited those lows that came in June. And this has happened in spite of, pretty close to the worst thing that could happen. So can other bad news come out? Yes, other bad news can come out. Realistically, if crypto.com goes down, it's probably not that significant because they're just not nearly as major a player as we see with FTX. And so the contagion is a lot less. Yeah, it's a terrible thing, but not the end of the world when we compare crypto.com to an FTX collapse. So that risk has already been removed. Yes, we have some kind of macro environment going on that's unclear. We'll see how that plays out with recession, et cetera, over the next, call it, year or so. But in the meantime, there's a reasonable chance of some sort of a bounce. You're probably not going to have regulations that are really extreme come in the next couple months. So in that sense, we probably have upside. You're probably not going to see any issues with tether. As I mentioned, funds are frozen, so they don't have to worry about trying to redeem them in that time. So that works out pretty well. And realistically, you're probably in a situation where the downward effects of tokens being sold off is pretty close to exhaustion. Like selling exhaustion is probably pretty high. I've heard a lot of people say like crypto is dead, institutions are not going to put money in unless there's regulation, et cetera, et cetera. Like that whole narrative is here. It's hard to see where all the sellers are going to come from who haven't already sold. And that's really positive. The last thing that's super positive about this is what you'll notice. I did a video back at the end of 2021, early 2022, sometime around then, talking a little bit about pricing and mentioning how one of the problems in the crypto space has been that it's too easy to launch a project or to launch a token. And so if you think of the average value of a project being the collective volume of money within the space divided by the number of projects. At first, if you look at, say, DeFi Summer 2022, you had money flowing into the space faster than new projects were launching, and so you had a lot of capital appreciation. When that capital appreciation comes in, what do you see? You see a lot of interest in people launching new tokens, right? So throughout 2022, what did we see? We saw GameFi, we saw NFTs, we saw a lot of kind of Me Too type DeFi, lots of new projects launching in the space, raising all kinds of money. Wonderful, great. That creates an ecosystem of innovation. But at some point, what happens is because prices are high, people start to take money off the table. They start to say, you know what, I'm going to sell. I'm going to go elsewhere with my money. And so prices on a relative basis aren't going up as fast or stop going up. There's more competition for the same amount of money. Now, then you see people start to withdraw money. Because people start to withdraw money, prices start to decline. As prices start to decline, people get margin called. All of a sudden, the leverage collapses and things go down a lot. After things go down a lot, companies say, well, we can't raise money anymore. This isn't so good. People are going to lose jobs, et cetera. And so you see a flight of projects from the space. And therefore, you're left with only sort of what I would call like the survivors in there. And that is the point at which we start to see the great point for investment, because you get allocation of talent consolidating to a few stronger projects, which is strong for those projects. Number two, you don't have a lot of people competing for capital, which means that capital can get distributed much better between the new projects that are coming up based more on kind of solid innovation, et cetera. And you're in a situation where gradually the rate of capital will go in faster than the rate of new projects, which will be positive for the projects. So I would suggest that probably, from now on for the next, call it 12 months, is probably going to be the period of time when the best opportunities are available. So I deployed a fair amount of capital, basically the day after, or the day that FTX went down, bought at some attractive prices for long-term holds. And I'm quite enthusiastic about the investment opportunities here because of the fact that I've seen something where, look, the prices didn't make new lows. Now, that's for me. I'm not going to tell you what you should do. You can do your own thing. For those who are interested, just briefly, most of the money that I put in this particular case was into what I would call like very solid blue chip projects that are going to be around long term. I'm not looking, I have capital already deployed in some of the things that I think have very high upside. And so I was looking more for places that I could put larger amounts of money at attractive prices that I'm probably not going to hold super, super long term, but that are likely to greatly outperform holding cash over the next 3 to 12 months. So I hope that helps. If you have any questions, put them in the comments below. If you'd like help with getting bank accounts, etc., please reach out to us, and I can look forward to seeing you on the next video.